Hello, everyone, and welcome to the latest quarterly investment outlook brought to you by eToro. I am Sam North, a market analyst here at eToro, and it is a pleasure to be your host here today to discuss investing in the Trump era, our quarter two 2025 investment outlook. Please do remember to like, share, and subscribe, especially if you're watching on YouTube. And remember, this is a marketing communication and should not be taken as investment advice, a personal recommendation, or an offer of or solicitation to buy or sell any financial instruments. Today, we are joined by the eToro Big Three, our very own Jordan, Pippin, and Rodman. Lale Akana, our global market analyst, Neja Molk, our market analyst, and Brett Kenwell, our US investment analyst. For those watching on YouTube, you can see them all waving at the screen right now, very excited to be quizzed about the previous and upcoming 3 months. So, Lale, let's get into it. What has stood out to you from the last 3 months, the first 3 months of the year? A lot has happened.
You're right, Sam. It's been a packed start to the year, from rate expectations shifting to tariff policy noise and sector rotations. The markets have had plenty to react to. What really stands out is the divergence across asset classes. While US equities, especially the big tech names, have pulled back, we have seen strong gains elsewhere, particularly in China and in European equities, and hedging portfolios through gold. So rather than one dominant global theme, what we have seen in first quarter is a story of rotation and repricing across geographies, across sectors, and obviously investor expectations. So let me try to break it down very quickly. China has been the clear standout with a strong rally year to date. It has been driven by aggressive stimulus from Beijing and a rebound in investor confidence, especially in consumer and tech names. Obviously, after underperforming for most of 2023 and 2024, China now seems to be regaining traction from investors. Gold is the second best performer so far, and it has been fueled by a weaker US dollar, rising geopolitical tensions, and increased demand from central banks and investors obviously seeking safety from increased volatility. It's a classic flight to quality story, and gold tends to shine when uncertainty rises. In Europe, the broader index is again showing very strong performance, supported by overall falling inflation, easy monetary and fiscal policy, and better than expected corporate earnings. And sectors like financials and industrials have led the gains, and investors are rotating back into the region after several muted quarters. So obviously on the flip side, the S&P 500 has lost around 2% year to date. NASDAQ has lost around 6% year to date. And the weakness that we're seeing in the index is largely concentrated in the Max 7 tech stocks, which have fallen around 11%. Investors are rotating out of these mega cap names after 2 years of outperformance, and there's increased scrutiny of valuations, especially as AI enthusiasm gets tempered by earnings reality. US cash performance is just barely positive. Again, it's reflecting still high short-term rates, but little capital appreciation. Turning to crypto, Bitcoin is down by 6%, snapping its recent bull run. I think part of the pullback is really profit-taking after the last year's rally, but also a reflection of overall risk of sentiment in markets, partly due to central banks delaying rate cuts, but also because of elevated policy uncertainty from the US. And finally, looking ahead to the second quarter and beyond, we have a really busy calendar. Major earnings reports obviously coming from tech and consumer giants. These will be key to setting the market tone and determining whether the current rotation that we're seeing in certain sectors continues. We also have a series of central bank rate decisions and inflation data due. Markets are pricing in rate cuts starting mid-year from the Fed and the ECB. And if those materialize, we could see renewed upside in equities and in fixed income as well. But one wild card is obviously trade policy. With the new US tariffs looming and global supply chains on alert, volatility could return very quickly. So Sam, just to sum it up, again, 2025 has started unevenly across multiple markets with strength in China, in Europe, gold, softness in US tech and crypto, but the tone is cautiously optimistic, and the key catalysts in second quarter may set the direction for the rest of the year.
Thanks, Lale. Cautiously optimistic. You know what? I'm going to take that. For those that are currently listening on the podcast, the link for YouTube is in the bio. You can find it there. And I want to know from all of you watching this now, what stood out to you the most? What, did you predict happening? What did you get surprised by? Was it China? Was it Europe? Was it gold's performance? Was it the underperformance of Bitcoin? Drop a comment below. It'd be interesting to see what you all think. Lale, now focusing on the next 3 months, what are some of the key drivers that we are focusing on?
Thanks. And yes, the next few months are going to be heavily shaped by policy signals and again, earnings clarity. We are calling this the year of policy uncertainty. And the second quarter is where a lot of that plays out. First, earnings will remain front and center. The market is already undergoing, again, a healthy correction, and we are starting to see performance broaden out beyond just mega cap tech. What's critical now is whether earnings guidance supports that rotation. If results from sectors like financials, industrials, and consumer names hold up, that would validate the idea that the average stock can continue to catch up. Second, trade policy is back in focus. The US is expected to announce a sector-specific and reciprocal tariff framework on April 2nd. And while markets have partially priced that in, the lack of clarity around the scope and timing does weigh on business decisions. And in our opinion, supply chains and input prices are still at risk. And in fact, that uncertainty may hold back CapEx decisions in the near term. Third, central banks are in a holding pattern at the moment. Obviously, after months of anticipation, we now have a synchronized pause in the rate cutting cycle, led by the Fed, but most recently echoed by the ECB and Bank of England as well. So policymakers are essentially waiting to see how inflation and growth will play out. And that pause doesn't mean rate cuts are off the table, but it does mean that the pace and timing are highly data dependent. So for markets, this creates potential volatility around the CPI and, say, labor market releases. And fourth, tech and AI continue to be the key drivers of equity performance, but the market is becoming more selective, in our opinion. And that is showing up in recent price action. In fact, several of the Mag 7 names have come under pressure this year as valuations have reset and the bar for execution rises. So while semiconductors have held up well, supported by the AI infrastructure demand, we are seeing softness in consumer tech and hardware, where monetization of AI remains slower. So in our opinion, for this quarter and onwards, the focus will shift to proof over promise on who is actually monetizing AI, not just building hype, but driving tangible margin improvement.
Thank you, Lale. Yeah, I've been bring it on. The next 3 months, I'm sure, are going to be as interesting, if not more, than the first 3 months of the year. And I always say this anytime we do one of these webinars or podcasts, depending which how you're viewing it. I love the community and I love these survey results, which you can now see on YouTube if you're watching. And we asked what asset class do people think will perform best in Q2, and it was interesting to see crypto came down from the same poll back in December, but commodities rose as well, which is kind of what you've seen in those first 3 months. So people are feeling like that is going to continue. And that same question, but about regions, Europe went from 9% from the December poll to 28% in our March poll. China as well, increasing 16 from 7. And then we look at themes as well. Crypto assets has moved lower from 30 to 24%. And robotics, interestingly, gone from 14% in December to 21% this time out. Thank you for everyone who got involved. 1,400 responses to the poll questions. And again, if you're watching on YouTube, let us know what you think. Is there an individual asset that you're really keeping an eye on over the next 3 months? Let's create that conversation. I'm always super interested to hear what you all have to say. Brett, now I'm coming to you. We're shifting our focus to the US. How are you seeing things over there at the moment? It doesn't seem like there has been a quiet day so far this year.
No, there hasn't. After a tumultuous first quarter, I think this chart is a little bit different than the number of charts we typically see, whether it's the S&P or the VIX. It's aptly named the U.S. Economic Policy Uncertainty Index. And in a world where a picture can be worth 1,000 words, I think this chart is worth at least that. And you can see how, over the last 25 years, really, this chart does a good job measuring these kind of key moments in certain markets. Where we go back to the 2008, 2009 great financial crisis. We go to, COVID around early 2020. We see these big spikes in uncertainty really around surrounding U.S. economic policy. And again, we're seeing it now. Really since the start of the year, there's been a big jump. A lot of that is obviously tariff related. But I don't think we need to spend too much time on it other than just to say, markets crave certainty, and we see what happens when uncertainty really spikes higher. We see that, sort of influence how the S&P is traded. So on the next slide, but we will talk about how it also impacts sentiment. Obviously, there's a lot of different ways to measure sentiment, but in this case, we're looking at the AAII survey. It's a weekly survey. And again, going back over the last 25 years, we don't tend to see these large spikes in bearish sentiment and these large declines in bullish sentiment outside of, really kind of key turning points in the market, key moments in the market. For instance, the bearish chart you see on the top, it really kind of only highlights the bottom, the low in the S&P from the prior bear market in 2022. A couple moments in the great financial crisis where we were kind of at an extreme in sentiment, and that kind of has correlated. Historically, we tend to see a correlation between sentiment and a turning point in the market. When sentiment gets too far to one side, we tend to see the opposite play out in equities. So for instance, if sentiment becomes too bearish, we tend to see a market bottom or put in some type of constructive bottom. And turn higher from there once we have what we call a washout. And it goes both ways. When sentiment gets too bullish, we tend to see a pause or a pullback in equities. And so, there's, I think, a lot of discussion right now whether the low that we've seen in March is going to be the low, given that sentiment has come down so much so quickly. There's also the concern that maybe sentiment this time around is more of a leading indicator, kind of getting out ahead of what we could see go down in terms of the economy or the labor market, and generally would not be viewed that way, would generally not be viewed as a leading indicator. The one unique perspective from this point is these washouts in sentiment tend to come when the S&P is near a low, near a bear market low, and the depths of the financial crisis. Those are pretty extreme moments. When we hit these extremes in sentiment, the S&P was not very far off of record highs. So there is always that concern that maybe this time around it is different and we're in for more downside. But I think in order for that to happen, we need to see a bigger deterioration in the economy. We need to see some of this uncertainty really start to filter through from the C-suite to the businesses to the consumers. And right now we don't see that. There's obviously the concern that happens, but right now the hard data does not show that exactly. So maybe there is this hope that sentiment will lead to that low in the markets. Time will tell, especially through Q2 and as we get through this earnings season. But Sam, if we move to the next slide, we can really see how this market has actually been sort of a sector-specific sell-off where consumer discretionary and technology stocks have been really what's weighed on the market. It's surprising. It surprised me to see 9 out of the 11 sectors are still higher year to date. Really, a bulk of this pain has been tied to just 2 groups. Unfortunately, those 2 groups account for roughly 40% of a 40% weighting in the S&P 500, a bulk of that being tech, of course, at about 30%. But, just because that weighs on the S&P doesn't mean that it shields or protects sentiment either, because technology and consumer discretionary stocks, those are investors' favorite names, whether that investor is an institution or it's a retail investor. These are investors' go-to names. These are mega cap tech. These are the brands they know and resonate well with. To see them get hit so much harder than the rest of the market, that inevitably, I think, is going to weigh on sentiment. And we're seeing it now in the survey numbers and in different, really, honestly, sentiment gauges. So I think that's one explanation behind it. But at the end of the day, we still have good market breadth. If you look outside of the US, as Lale alluded to, we do see a lot of strength in international markets, in other asset classes like gold. So it's really, a lot of this pain has been tied to a very specific subset of a specific market, that market being the US equity markets, the S&P 500. So we kind of started off with a view from 30,000 feet, talking about economic policy uncertainty, maybe kind of zoomed in more to a 5,000 view from 5,000 feet. But now if we kind of pull back a little bit, I want to talk about inflation. That has become kind of a big fear in Q1. And I know it kind of feels like ancient history to go back to January, but it was really just a few months ago. Coming into the year, we had that jobs report in the beginning of January. And markets sold off on a pretty strong number. There was this fear that wage growth and strong jobs growth was going to drive a reflationary rhetoric through 2025 and really put the Fed in a tough position and put the markets in a tough position. Now, that fear has quickly faded, more so to being focused on the economy and the labor market as a whole, but there's still this fear that we're going to have a reflationary spike, particularly with the inflation discussion. That is a concern, just to be clear. If we were to see a large sustainable spike in inflation, that would put the Fed in a tough position. It would be a difficult environment for the economy to navigate through. But on the plus side, there are positives around inflation. So some of those are specific positives, like when we look at the inflation reports specifically, we see what's called services inflation, or the sticky components to inflation. We are seeing progress continue to be made there. Services being things like shelter or insurance costs. It's really the goods side of the equation that has seen a spike in recent reports. So the good news is we could see that temper off throughout the year. Obviously, it's a little noisy right now with the tariff discussion, but the S&P does not, inflation is not the end all be all for the markets, for the S&P 500. If we looked back over the last 50 years, the index averaged an annual gain of about 10.5%. In the years where inflation was contained between 2 and 4%, markets actually performed pretty well, outperformed the baseline case. Whereas when inflation was sub 2%, markets tended to underperform. Now, it's more complicated than that, unfortunately, just because inflation is between a certain level doesn't guarantee that equities are going to outperform or underperform. But I think it's just a good way to visualize that inflation doesn't have to be this big scary monster. It can be, if it's contained and it's mild, it can be a good thing for equities.
Thank you, Brett. And Neja, we'll move on to you, my partner in crime on the Market Bites and the Stock Break superstar. So everyone, do remember to like, share, subscribe, all of that. But Neja, we'll focus on rotation, and there's been a lot of noise about that in recent times. Have we been seeing that this year? What has stood out for you as well, and how do you see things developing over the next 3 months?
Yeah, so in the beginning of the first quarter, we pointed out these increasing opportunities beyond Magnificent Seven. We already talked today about this concentration, and already in the first quarter, we said that their rapid growth was beginning to seem a bit unsustainable. And fast forward to today, the market has confirmed our outlook, because these tech giants have underperformed in recent months, weighing on SP 500. And this shift is really significantly marking this change in investor sentiment and suggesting that broader rotation is underway. And if we take a look at the numbers, for example, year to date, the SP 500 has underperformed its equal weight counterpart by about 2%, and the gap has been even bigger in the past few weeks. So this is a signal that smaller and mid-sized companies are starting to take the lead. And unlike the traditional version of SP 500, which is heavily influenced by biggest names on the market, the equal weight version gives every company the same level of importance, and its stronger performance could suggest that investors are moving away from this mega cap dominance and looking for opportunities elsewhere. And we already talked about sectors today, and this rotation is creating opportunities in areas that have been overlooked for quite some time now. We see more attraction gaining in defensive sectors such as healthcare, consumer staples, utilities, because investors are looking for more stability. And for those who want to gain more exposure to this shift, there are some ETFs that can provide an efficient way to tap into those emerging opportunities. One example is SP500 equal weight ETF, which is a great way to move beyond this concentration risk of traditional SP500. And it is offering more balanced approach to market exposure. Now, if we move to one other market that has been gaining a serious momentum, let's talk about China. Because when we enter the second quarter of 2025, China's investment landscape has been evolving at a fast pace, and it is fueled by groundbreaking technology, diversifying economy, and also strategic expansion into high growth industries. One of the most exciting developments recently is no doubt the development of DeepSeek, because their Air 1 model is delivering performance that can be compared with top-tier AI models, just like OpenAI's ChatGPT. And what is making this DeepSeek a breakthrough is the fact that it was developed at a fraction of the cost. And this is a game changer for all investors in the field. And this current situation can also remind us of some past market dynamics, such as dark fiber boom 25 years ago, for example. This was the time when this overcapacity emerged. And so similarly, DeepSeek could warn us that we could see a similar scenario with AI chips, which could potentially lead to a glut of graphical processing units or GPUs. And I know that most of the conversations around China emerge around big tech companies like Alibaba and Tencent, but there are investment opportunities beyond those tech giants. One example is Kingsoft Cloud Holding, which is a major cloud service provider in China, and they have smartly integrated DeepSeek AI model in their services. And with that, they are making cloud offerings more advanced and scalable. However, Kingsoft is not the only company in AI, and their services are evolving rapidly. So there are also ETF options that provide exposure to overall this growth sector. And one of these examples is China Internet ETF, which is targeting China's top internet and tech companies, including those that are driving this AI revolution. But of course, China is not just about AI and cloud computing. There are other sectors that are quietly making waves, and one of them is biotech, because Chinese biotech firms have emerged as global players. They are offering one major advantage over Western counterparts, and I would say this is speed and efficiency. They can conduct clinical trials faster and cost effectively, leading to development of bio-better drugs, which are attracting major foreigner investments. And the data is highlighting this shift because in 2020, less than 5% of major pharmaceutical deals involved Chinese companies, but by 2024, that number has surged to nearly 30%, which is reflecting Chinese growing influence in global drug development. I think one of the key moments came last year when Summit Therapeutics company announced that their drug, which was originally developed by Chinese biotech company Akeso, outperformed Merck's $30 billion Keytruda, a lung cancer drug, which marked a significant biotech breakthrough. And I think this is mirroring what is happening in China's tech industry, because just like DeepSeek built a world-class AI model on lean budget, Chinese biotech firms are moving fast and they are using highly skilled workforce and lower costs to develop better treatments at record speed.
Thank you, Neja. And I'll tell you what, when you mentioned DeepSeek, then it just seems like that was 6, 7, 8, 9 months ago. But in reality, it's this year. I'll be interested to know for those on YouTube. Let me know in the comments, how do you see China versus the US performing over the next 3 months? What do you think is going to come out on top? Get those comments into the chat. Meanwhile, while you all do that, Lale, we can't really do this presentation without talking about the year-to-date rally in Europe. What are your thoughts on that? And also, why do you think it matters?
Definitely. Look, Europe's rally has been one of the standout stories in the first quarter of 2025. And currently there is an ongoing debate over whether this is just a tactical allocation from investors or in fact the start of a long-term shift. What is supporting to move, in our opinion, is a more investor-friendly policy mix. The ECB is easing, fiscal constraints have loosened, especially in Germany, and valuations are still compelling compared to the US. And obviously, the massive defense and infrastructure plan that was announced by Germany is a major catalyst here, particularly for defense stocks, which rallied on the news. But are we approaching more a buy the rumor, sell the news phase, where markets pause to reassess where actual earnings growth can justify the price move, is the question that we're asking right now. And that really brings us to the core issue, which is profit margins. And the chart here highlights something important, that the current rally has occurred without meaningful improvement in margins. And that's exactly what we saw in 2015 to 16, which ultimately led to the rally losing steam. So while investor sentiment is positive, earnings growth will be essential to keep this ongoing. And we have seen that early strength, in fact, in financials and semiconductors, and those sectors are key to this story. And why does this matter in the broader context? Because Europe is increasingly part of a structural rotation away from pure cyclicals into a more balanced, policy-driven themes like infrastructure, defense, and industrials. And it also offers diversification at a time when the US market remains very concentrated and quite expensive. So overall, we like Europe here, not as an all-in allocation, but as a part of a global portfolio. And if margins do improve and earnings come through, this rally could mark the beginning of something more secular. But without that follow through, this could stall, just like it did in previous cycles.
Thank you, Lale. All eyes are going to be on that. And that brings us to the 2025 investment outlook. Can you give our audience a brief summary of this, please?
Absolutely, Sam. Look, 2025 outlook continues to support a more pro-risk yet diversified approach to asset allocation with selective hedging against market volatility, in our opinion. So let's start with the macro backdrop. We're looking at a more moderate global growth, moderate inflation environment, and lower interest rates, which is a combination that typically benefits risk assets. So sectors tied to liquidity and rate sensitivity, so think of, say, commodities, gold, certain equities, and even crypto, they may benefit in this environment. And don't forget that there is also actually a lot of cash sitting on the sidelines. And as central banks pause and continue to ease their rate cutting cycle in the next few quarters, we expect that capital gradually being put to work. In terms of regional equity views, we still maintain a pro-risk bias with a tilt towards developed markets. We talked about already about Europe. US value is interesting. We favor mid and small caps, especially domestic and cash generating sectors as well. And we are seeing early signs of broadening in equity performance beyond the mega cap names. And this is particularly important because we believe services in general are better insulated from tariff policy. Chinese equities, they continue to look compelling. Valuations are still at around 65% of US counterparts. Again, more fundamentally, we are seeing renewed government support with high-level engagement from leaders, and they're signaling a more market-friendly stance overall. For long-term investors, this may remain an area of interest, even as geopolitical risk tensions linger. Again, one of the core themes this year is a shift from pure cyclicals into structural winners. And we're moving into a place where fiscal support and national security policy will start to shift the market leadership. And that includes, again, infrastructure, defense, home building, and manufacturing. And these are not just tactical trades, in our opinion, they're becoming part of the more long-term positioning in portfolios. Crypto is obviously a question that we get a lot from investors. It's, in our opinion, again, despite the recent volatility that we have seen, it's benefiting from longer holding periods and institutional adoption, and a policy environment that is more accommodative than restrictive. And we continue to view crypto as a portfolio diversifier. Lastly, in fixed income, in our opinion, cash, again, is losing its edge. We favor US Treasuries over cash. Inflation-protected bonds are getting more interesting as a hedge, potentially to a resurgence in inflation. So overall, it's a constructive setup, but success in 2025 will come down to selectivity. And this is not a market to chase beta, in our opinion. It's a market to be thoughtful, diversified, and be focused on where policy, pricing power, and structural momentum intersect.
Thank you, Lale. And for those that are listening or watching and wondering where you can get the House Outlook every week, actually, you can get it on the news and analysis page on eToro's. So do check that out. Now, guys, it's time for my favorite part of these outlooks. We're going to go through 2 questions each. You all know the rules by now, but if you're tuning in for the first time and you're watching or listening to this, our team have been given 2 questions sent in by all of you at home, and they have to answer in under a minute. Brett, you are up first, and the first question that was sent in: is the sell-off in tech an opportunity or a warning sign?
You know, I think given how well tech has performed over the last several years, if we were early stages of this pullback, I would think it's not compelling enough of a dip to get involved, or it's still too early, would be more of a warning sign. Given how much some of these names have pulled back, though, and given the fact that tech is actually expected to have the best earnings growth this year, to me, at this down 20 to 25% for a lot of these Magnificent Seven names, that does start to become more compelling. Again, as Lale mentioned regarding a different asset, not in an all-in type of format, but something where you start to nibble and start to find some opportunity with a longer-term mindset involved.
Thank you, Brett. And under 1 minute, well done to you. Neja, your first question of the 2: how to balance exposure between mega cap stocks and emerging market leaders?
I will try to keep this one under 1 minute, but I would say that this requires a diversified approach that considers both long-term growth potential and also market cycles. Lale talked a lot about it, and we could say that mega caps can offer stability, but they're also sensitive to overvaluation. So it is key to diversify with other sectors and other markets as well. Emerging markets, on the other hand, they can offer high growth potential, but they come with their own set of risks. So I think that monitoring those macroeconomic conditions, such as interest rate trends, is crucial, and active management of portfolios with frequent rebalancing can help adjusting this exposure. So by balancing those strategies, I think that we can all optimize our portfolios for long-term growth by aligning our financial goals and also risk tolerance.
Thank you, Neja, and thank you for sending in that question, guys, at home. Lale, your first question. We've talked a lot about growth and volatility, but what about income? Dividends often get overlooked in fast-moving markets. How should investors think about their role in portfolios as of right now?
That's a great question, Sam, and one that actually investors often overlook. Look, in such a volatile market, dividends can actually provide a sense of stability. They essentially are a way to earn a steady stream of income while you ride up the ups and downs of the market. What's often also underestimated is how much compounding dividends does actually contribute to long-term returns. So we say for retail investors thinking long-term, dividends can serve two important roles. The first one is actually reduce the reliance on market timing, but also build wealth steadily.
Now, Brett, time for your final question. How does crypto fit into a portfolio of mostly US stocks?
Well, a key theme so far this quarter has been diversification, whether that's mostly US stocks on a sector by sector basis or protecting yourself from some of those pullbacks we've seen in tech and consumer discretionary. And like Neja pointed out, how that equal balance approach can be, rewarding in markets like this, or if it's more like Lale was talking about, having exposure to broader asset groups, be it precious metals, cryptocurrencies, foreign and US stocks. All of that can help not only protect your portfolio, but also enhance your gains in different market environments. And crypto, of course, is not immune to that volatility that we're seeing in US stocks. But again, I think when investors zoom out and really consider how well it has performed over the longer term, I mean, crypto might be down. Bitcoin may have pulled back in this quarter, but even when we go back just 12 months, it's still up close to 25%. That's a great return in 1 year. So I think when we zoom out and have a longer term perspective, it really reiterates how strong crypto can enhance a portfolio's return when it's done in a diversified manner.
If in doubt, zoom out. Neja, time for your final question. What risks should investors consider when looking at China's AI and biotech sectors?
Well, with every investment, there are risks included, and here is obviously no different. There are several risks that we should talk about. First, there is regulatory environment in China that is quite unpredictable. Changes in policies regarding data usage and drug approvals, that all of that could affect biotech and also AI companies. Second, there are ongoing political tensions, and all of these sanctions could affect sector growth, and also limited transparency and inconsistent reporting standards in China companies can lead to concerns over those companies and those sectors. So as always, investors should think broad, keep diversified, and they should take those risks into consideration before investing.
Thank you, Neja. We've gone 5 for 5 under a minute. Lale, no pressure. The final question is all yours. And you know what? We've got to talk about tariffs. With April the 2nd flagged as a key date, how should investors be thinking about the sector level impact? Are there any specific industries that could come under pressure if we see broad-based tariffs implemented?
Yes, indeed, April 2nd is a key inflection point, Sam. Look, we are overall saying that goods producing sectors are more at risk and more sensitive to tariffs overall versus services oriented sectors. And it goes back to, again, our points earlier about being very selective in which sectors and which companies you're allocating to this year. We're thinking that, again, industrials and autos are especially vulnerable. Companies that have deep cross-border supply chains could get hit from even small changes in tariff policies, and therefore see a pressure on their margins as well. Retail and consumer goods, again, could be hit, especially those companies that are heavily reliant on imports from Asia and, say, Mexico and Canada. Tech is, again, a sector that could be sensitive depending on obviously whether that company has significant manufacturing exposure, say in China. Again, any escalation there could raise costs and delay production timelines, and therefore, again, hit margins, the performance, and so forth. So be selective, do your homework in understanding which companies are going to be more affected.
Thank you, Lana. Be selective and do your homework. I like to finish on that note there. And also for anyone listening or watching, if you're still watching right now, you clearly enjoyed it. So do remember to like, share, subscribe, and remember, digest and invest by eToro on all podcast platforms. Give us a rating as well. Why not? Literally can't think of a reason. But that brings us to the end. Neja, Lale, and Brett, thank you very much for joining us for our Q2 investment outlook. Thank you.